Hello and welcome to a brand new show of Market Makers. Post-budget, foreign institutional investors have been net buyers, but domestic institutional investors, especially insurance players, they've been net sellers. My guest on the show today manages about $6.5 billion of equity investments in India. He certainly is the biggest equity investor from the private insurance space. Puneet Nanda, Executive Vice President of ICICI Prudential. Now, before I introduce him, a profile of him.
The country's largest investor in private sector insurance today has to be one of India's eternal bulls. Puneet Nanda, the Executive Vice President at ICICI Prudential Life Insurance, who manages $6 billion today, started off as a fixed income trader in the early 90s. The insurance boom is far from over, he snares, as the Indian middle class is still growing and evolving. Ask him for one investment tip, he will give you two. Never put all your eggs in one basket and know your downside before you plan your upside.
Puneet, good to have you on ET Now. Thank you for joining us. Before we look at specifics and talk about what you're buying and what you're selling, characterize the market environment for us.
I think it's a very interesting market environment, and you have to look at both the global scenario as well as the domestic scenario. From the bottom that we saw, let's say early 2008, the Indian market's up 100%, right? And there are a number of factors for that. The primary factor I would say is the global liquidity surge that happened. So globally, every country was pretty much down the barrel. Economies were contracting, unemployment rate was shooting up. So huge liquidity surge happened, and obviously that helped all the emerging markets and specifically India. Then within that, what happened was emerging markets were able to withstand the meltdown far better because the economy was doing much better, and then there were different reasons for different economies. So for example, in India, very little export dependence, so that helped. We are a domestic consumption economy, so that helped. But net what has happened is that emerging market bond spreads, which were at about 800 basis points at its worst, are down to about 250 basis points or thereabout. So that helped allocation to equity. And finally, on the domestic front, what happened was that on the margin, the economic fundamentals were continuously improving. We will end this year at a GDP growth rate of maybe 7.5% or thereabouts. Next year looks like 9%. All helped. And then finally, because of all this, the global flows to Indian markets have really surged. We have seen a scenario where over this last year, $20 billion, highest ever, has come into Indian markets from the foreign shores. All this has clearly helped the market. The domestic institutional investors have anyway come of age. In fact, irrespective of market conditions, domestic institutional investors have been serious and consistent investors in the Indian market. So, just to give you some data, for example, last financial year, FY09, ended March 09, domestic insurance companies alone invested something like $12 billion. And the numbers for FIs, it was negative $10 billion. The year before that, year ended FY08, also domestic institutional investors, particularly insurance companies, had invested about $10 billion. FIs were at that time also $10 billion. So it's been a consistent journey that way. I think all that is helping the market, but net, I think the most important thing for the market is what is happening to companies, what is happening to earnings growth, what is happening to the corporates, their own plans, their profitability. And on the margin, clearly things are improving. This year we will probably see earnings growth which will be maybe low single digits. But as you know, equity markets discount the future. Next year we are looking at earnings growth of maybe 20%. That is giving a lot of confidence.